Today, I'm going to talk about an alternative investment stream when we're in a lower interest rate environment. Maybe we want to shy away from bonds and maybe we don't want to invest in some annuities. If this is your first time at our channel or you haven't subscribed, click on the subscribe button at the bottom. My name is Travis Sickle, certified financial planner with Sickle Hunter Financial Advisors. When you're looking at creating an investment income stream, there's a few things that you can take a look at. You can look at something passive like real estate, or you can look at something like an investment like bonds or annuities. All these different sources can provide different income streams. Unfortunately, in this low interest rate environment, things like bonds and CDs, they're struggling. CD rates are extremely low relative to the rest of the market. And the bond prices, as rates continuously rise, it's going to be a very difficult bond market. So where do you invest if you don't necessarily want to go right into the stock market, but you want a little bit more return? One of those investment income streams is taking a look at a structured note. Now, there's a lot of different structured notes out there, but the one that I'm going to talk about today is called the auto callable contingent interest note. What makes this note so interesting is the income stream is extremely high relative to almost anything else out there that you can find. Right now, it's yielding between 7 and 11%. Now, those rates are going to change depending on the market, but right now that is the yield that we can get on an annual basis. And the nice thing is some of these notes are paying out monthly and quarterly. That means you're getting 2 to 3% on a monthly basis. And the way that these notes work is usually they're linked to multiple indices like the S&P 500 or the Russell 2000. So you put the money into the investment and it gives you a dividend, as long as, depending on how the market's doing and those indices are doing, will be dependent on whether or not the interest is paid out. In addition, it has up to a 30% downside protection. Now, these are the notes that are currently available, and they can be customized to have more or less downside protection, but most of the notes today are at 30% downside protection. So what does that mean? So if you're invested into a structured note, and take the S&P 500 for example, if the S&P 500 goes down 5%, if you were invested in the stock market, you would lose the 5%. Well, in the structured note, it would continuously pay that interest, but you would have that downside protection. If you were invested in one of these notes and it's linked to the S&P 500, and let's say the S&P 500 goes down by 10%, that note continuously pays. Now, if the market doesn't go below the 30% threshold, then you don't lose anything and you get back your principal plus all of the accrued interest that you've already received. So that's a pretty good investment. Now, if the market goes down 30% or more, then you have what's called market participation. But that wouldn't be any different than if you were invested in an index fund in the S&P 500. So if in the index fund, if the index went down by 30%, you would have lost 30%. In the structured note, you're protected up to that 30% threshold, or depending on what that note has as its trigger point. Now, that could change depending on the note. Now, the second downside to the structured note is looking at the upside or the opportunity cost. Now, in that same example, if we were invested in the S&P 500 and the market went up by 10%, you would get 10%. That's how much your investments would have performed or improved. Well, if you were invested in the structured note and it went up, then you wouldn't receive any of that upside potential, but you would get your money back because these are called auto callable. So as soon as they go above the threshold, which is 0, then it gets called and you get return of principal. Now, each note is set up a little differently, but this is one particular note that could be valuable in the right situation if you're trying to produce an income stream and looking for an alternative investment source. These notes can vary from 12 months up to 5 years, and they're offered in commission-based and fee-only accounts. So it's really important that you understand which type of structured note and which type of structured product that you're investing in. If you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.